Critical Men Pictures presents the Forex Video Training Series. Black Belt, Second Degree, US Dollar Index. If you've traded stocks, you're probably familiar with all the indices available, such as the Dow Jones Industrial Average, Nasdaq Composite Index, Russell 2000, S&P 500, and the Wilshire 5000. Well, if U.S. stocks have an index, the U.S. dollar can't be outdone. For currency traders, we have the U.S. Dollar Index, or USDX. The U.S. dollar index consists of a geometric weighted average of a basket of foreign currencies against the U.S. dollar. Huh? Okay, before you fall asleep after that definition, let's break it down. It's very similar to how stock indices work, and it provides a general indication of the value of a basket of securities. Of course, the securities we're talking about here are the other major world currencies. The basket that the U.S. dollar index consists of six foreign currencies. They are the euro, yen, pound, Canadian dollar, krona, and franc. Here's a trick question. If the index is made up of six currencies, how many countries are included? If you answered 6, you're fucking wrong. If you answered 21, good job. There are 21 countries total because there are 16 members of the European Union that have adopted the euro as their sole currency, plus the other 5 countries, Japan, Great Britain, Canada, Sweden, and Switzerland, and their accompanying currencies. It's obvious that 21 countries make up a small portion of the world, but many other currencies follow the U.S. dollar index very closely. This makes the USDX a pretty good tool for measuring the U.S. dollar's global strength. Now that we know what the basket of currencies is comprised of, let's go back to that geometric weighted average part. Because not every country is the same size, it's only fair that each is given an appropriate weights when calculating the U.S. dollar index. These are the current weights. With its 16 countries, euro make up a big chunk of the U.S. dollar index. The next highest is the Japanese yen, which would make sense just since Japan has one of the biggest economies in the world. The other 4 make up less than 30% of the USDX. Here's something interesting. When the euro falls, which way does the US dollar move? The euro makes up such a huge portion of the US dollar index, we might as well call this index the anti-euro index. Because the USDX is so heavily influenced by the euro, people have looked for a more balanced dollar index. More on that later. First, let's go to the charts. How to read the dollar index. Just like any currency pair, the USDX even has its own chart. First, notice the index is calculated 24 hours a day, 5 days a week. Also, the USDX measures the dollar's general value relative to a base of 100. Okay, for example, say the current reading is 86.212. This means the dollar has fallen 13.79% since the start of the index. 86.212 minus 100. If the reading was 120.650, it means the dollar's value has risen 20.65% since the start of the index. The start of the index is March 1973. That is when the world's biggest nations met in Washington, D.C., and all agreed to allow their currencies to float freely against each other. The start of the index is also known as the base period. The US dollar index formula. This is strictly for the grown and the geeky. Is a formula for calculating the USDX. It is 50.1434812 times euro dollar. Okay, I'm not even going to go into that. I'm fucking kidding. I bet you're wondering, how do I use this thing in my trading arsenal? Well, hold your trigger finger and soon you'll find out. We all know the most widely traded currency pairs include the US dollar. If you don't know, some that include the US dollar are the euro dollar, pound dollar, dollar Swissy, dollar yen, and dollar CAD. What does this mean? If you trade on any of these pairs, the USDX can be the next best thing to sliced bread, or hamburger on a bun, or chocolate ice cream. If you don't, the USDX will still give you an idea of the relative strength of the US dollar around the world. In fact, when the market outlook for the US dollar is unclear, more often times than not, the USDX will provide a better picture. In the world of Forex, the USDX can be used as an indicator that's the US dollar's strength. Because the USDX is comprised more than 50% by the Eurozone, Euro-US dollar is quite inversely related. Let's take a look at the Euro dollar. It's like a mirror image. If one goes up, the other most likely goes down. What will you look at? It seems like the trend lines almost inversely match up perfectly. This could be a big help in trading Euro dollar. Some of our trader friends in the forums monitor the USDX as an indicator for the Euro dollar. Hang out with them if you want to learn more about the index. If the USDX makes significant moves, you can almost surely expect currency traders to react to the movement accordingly. Both the USDX and spot currency traders react to each other. Breakouts in spot USD pairs will almost certainly move the USDX in similar breakout fashion. To sum it all up, currency traders use the USDX as a key indicator for the direction of the US dollar. Always keep in mind the position of the US dollar and the pair you are currently trading. For example, if the USDX is strengthening and rising and you're trading the Euro dollar, a strong US dollar will show a downtrend on the Euro dollar. If you're trading a pair in which USD is the base currency, such as the dollar Swissy, a rise in the USDX will most likely show a rise at the dollar Swissy charts. Here's a little tip you should always remember. If the US dollar is the base currency, then USDX and the currency pair should move in the same direction. If US dollar is the quote currency, then USDX and the currency pair should move in opposite directions. The dollar smile theory. Ever wonder when the dollar strengthens both in times of tough luck but the economy is moving? Well, so does everyone else. In fact, this bloke over at Morgan Stanley came up with a theory to explain this phenomenon. Stephen Chen, a former currency strategist and economist, came up with a theory named the dollar smile theory. His theory depicts three main scenarios directing the behavior of the US dollar. Here's a simple illustration. Scenario 1. Dollar appreciates due to risk aversion. The first part of the smile shows the US dollar benefiting from risk aversion, which causes investors to flee to safe haven currencies like the dollar and the yen. Since investors think the global economic situation is shaky, they are hesitant to pursue risky assets and would rather buy a less risky US dollar regardless of the condition of the US economy. Scenario 2. Dollar drops to a new low. The bottom part of the smile reflects the lackluster performance of the greenback as the U.S. grapples with weak fundamentals. The possibility of interest rate cuts also weigh the U.S. dollar down. This leads to the market shying away from the dollar. The motto for the U.S. dollar becomes, sell, sell, sell. Scenario 3. The dollar appreciates due to economic growth. Lastly, a smile begins to form as the U.S. economy sees the light at the end of the tunnel. As optimism picks up and signs of the economy recovery appear, sentiment towards the dollar begins to pick up. In other words, the greenback begins to appreciate as the U.S. economy enjoys stronger GDP growth as expectations of interest rate hikes increase. This theory appears to be in play when the 2007 financial crisis began. Remember when the dollar got a huge boost at the peak of the global recession? That's phase 1. When the market eventually bottomed in March 2009, investors suddenly switched back to the higher-yielding currencies, making the dollar the winner of the Worst Currency Award for 2009. So will the dollar smile theory hold true? Only time will tell. In any case, it's an important theory to keep in mind. Remember, all economies are cyclical. The key part is determining which part of the cycle the economy is currently in.